Did you know that a staggering 75% of individual investors actually lose money due to a handful of incredibly common, yet entirely avoidable, mistakes? That's right, 3 out of 4 people end up with less than they started with, simply because they fall into predictable traps. And today, I am diving deep into these biggest blunders that could literally cost you thousands. And trust me, we're going to arm you with the knowledge to avoid them all. The world of investing is exciting, full of potential, but it can also be a minefield. The goal isn't just to pick the right stocks or funds. It's also, crucially, about making the wrong moves. These mistakes aren't just minor missteps. They are fundamental errors in judgment and strategy that consistently lead to significant financial losses for countless individuals. Understanding these pitfalls is the first, most important step towards making informed decisions and building genuine wealth. My aim today is to shine a light on these traps so you can navigate the market with confidence and keep your hard-earned money growing, not shrinking. So, let's break down these common pitfalls. The first, and arguably the most destructive, is emotional investing. This is where your feelings, like fear or greed, dictate your financial decisions rather than logic or a well-researched strategy. Think about it. A stock takes a sudden dip and panic sets in, leading you to sell everything at a loss, even if the underlying company is still strong. Or, everyone's raving about a hot new stock, and FOMO, fear of missing out, drives you to buy in at an inflated price, just before it crashes. We've all seen it or felt it. This emotional roller coaster can sabotage even the best investment plans. The market is designed to transfer money from the impatient to the patient, and emotions often lead to impatience. Next up, we have the glaring mistake of lack of research. This is essentially investing blind. It's like buying a car without ever looking under the hood or taking it for a test drive. Many investors jump into an asset because a friend recommended it, or they saw it trending online, without truly understanding what they're buying. They don't look at the company's financials, its industry, its competition, or its future prospects. They don't grasp the concept of diversification, putting all their eggs in one basket. This isn't just about picking individual stocks. It applies to any investment vehicle. Without due diligence, you're not investing, you're gambling. And in the long run, gambling rarely pays off consistently. Following closely behind is ignoring market trends and economic indicators. This isn't about perfectly predicting the future. No one can do that, but it is about understanding the broader economic landscape. For example, if interest rates are rising, certain sectors might struggle, while others might thrive. If inflation is high, the purchasing power of your cash decreases, making investing even more critical. Failing to keep an eye on these larger forces means you might be swimming against the current without even realizing it. You might be investing in industries on the decline or holding assets that are particularly vulnerable to current economic conditions. It's about being aware of the tide, not just the waves. Let's dive a bit deeper into each of these. Take emotional investing. One common scenario is buying high and selling low. We see a stock climbing, everyone's talking about it, and we jump in, often right at its peak. Then, the market corrects, the stock drops, and overwhelmed by fear, we sell everything, locking in our losses. If we had simply held on, or better yet, bought during the dips, the outcome could have been vastly different. The key here is developing a disciplined approach. Set clear entry and exit points, before you invest, and stick to them. Don't let daily fluctuations or sensational headlines sway your long-term strategy. It's incredibly hard to do, but it's vital. A good tactic is to automate your investments, taking the emotion out of when to buy. Regarding the lack of research, think about the dot-com bubble of the late 90s. Many people poured money into internet companies with little to no revenue, let alone profits, simply because they had .com in their name. The promise was alluring, but the fundamentals were non-existent. When the bubble burst, countless investors lost everything. Today, we see similar patterns with certain speculative assets. It's not enough to believe in a product or a concept. You need to understand the business model, the valuation, the competitive advantage, and the risks. Before you invest, ask yourself, do I truly understand what I own? Could I explain this investment to a 10-year-old? If the answer is no, then you probably haven't done enough research. And when it comes to ignoring market trends, consider the energy sector. For decades, traditional oil and gas companies were dominant. But with the global shift towards renewable energy and climate concerns, investors who remain solely focused on fossil fuels without acknowledging the evolving landscape might have missed out on significant opportunities in green tech or worse, seen their traditional holdings decline. This doesn't mean abandoning old industries entirely, but it does mean adjusting your portfolio and strategy to reflect broader shifts. Staying informed about technological advancements, regulatory changes, and demographic trends can give you a significant edge. It's about adapting, not just reacting. Now, let me share a story that really hammers home the dramatic impact of these mistakes. This isn't my personal story, but one I observed closely from a colleague years ago. Let's call him Alex. Alex was a brilliant guy, super smart in his field. But he came into investing with a bit of overconfidence and a lot of emotion. He got wind of a small tech stock that was showing incredible daily gains. Everyone was talking about it. He saw his friends making quick money, and the FOMO hit hard. Without doing any real research into the company's financials, its business model, or its long-term viability, he decided to go Elon. He wasn't just investing, he was speculating wildly. He poured a significant chunk of his savings, nearly $50,000, into this one stock. For a couple of weeks, it seemed like he was a genius. Then, almost as quickly as it rose, the stock began to plummet. It wasn't a gradual decline, it was a free fall. First, 10% in a day, then 20%, then 30%. Alex watched his paper gains vanish, but he couldn't bring himself to sell. He kept telling himself it would bounce back, that it was just a temporary dip. He clung to the hope, fueled by the memory of his past gains, refusing to acknowledge the reality of what was happening. His initial emotional high had turned into an emotional paralysis. He ignored every rational instinct and market trend, which clearly indicated the company was in serious trouble. Within a month, the stock was trading at pennies. Alex lost almost all of his original $50,000. The emotional toll was immense. He was devastated, not just by the financial loss, but by the crushing weight of his own poor decisions. This wasn't a case of bad luck. It was a textbook example of emotional investing run amok, compounded by zero research and a complete disregard for obvious market signals. It was a painful, expensive lesson that cost him years of saving and a huge blow to his confidence. His story is a powerful reminder that even smart people can make incredibly costly mistakes when emotions take the driver's seat. So, to recap these crucial takeaways, avoiding financial ruin in investing primarily hinges on conquering three giants: emotional investing, lack of thorough research, and ignoring broader market trends. Understand that the market will always test your patience and discipline. Your emotions are powerful, but they are terrible financial advisors. Always do your homework, know exactly what you're putting your money into. And finally, keep an eye on the bigger picture. The economy and market trends are not just background noise, they are essential context for your investment decisions. Educating yourself and staying disciplined are your best defenses against these common traps. It's not about being perfect, it's about being informed and strategic. So, tell me, have you ever experienced a similar investing blunder, or perhaps seen someone make these mistakes? Share your stories and insights in the comments below. Let's learn from each other. And if you found this video helpful, please give it a thumbs up. Hit that subscribe button and ring the notification bell so you don't miss my next video, where we'll dive into smart investing strategies to help you build lasting wealth.